Viv, before we get into Standard Bank, I just want to get your feel on banking in general. We saw Fitch revising the outlook on SA banks to negative, and the banks that were affected were Nedbank, First Rand and Standard Bank. Looking back to 2008, American rating agencies got some high-level structured finance rating categories absolutely wrong. And this brings the relevance of rating agencies to question. What's your comment?
Yes, I mean, look, even looking more recently, look at what's happening with S&P, with every country's downgrading, and amazingly enough, if you downgrade the country, you can expect the yield of the country to actually fall instead of rising as we normally expect. Some of the rating agencies in 2008 got their calculations entirely wrong, got their assumptions about risk just off the board, and they're now being a bit more on the other side. They've actually swung the pendulum, too far on the other side. They've gone from being too risk loving to being too risk averse. Okay, and in South Africa, in terms of the kind of ratings we're getting through, I mean, we also had a downgrade come through for the country as a whole, not just our banking system. That's politically driven in terms of what the new government's doing, or what the government's doing, what the forecasts are, etc. for the future. I do think some of the assumptions about South Africa are a bit too, cautious. I don't think we are as bad off as some of these agencies are believing at the moment.
Let's go to Johny now in Cape Town and get his sense on the banking sector in general before we move on to Standard Bank. I just want to get your take on how lenders plan to grow their revenues from fees this year, because it looks like there isn't much optimism around that. And in terms of growing interest revenue, the two main drivers are quantum of loans extended and the interest margin. And the ability of banks to extend their loans is more of a function of the country's ability to take on debt. But with debt to income ratios as high as they are in South Africa, hovering around 70%, is there much potential for banks to grow loans extensions this year?
Well, historically, going back to the 60s and the 70s, banks have been able to grow their advances in South Africa by around sort of 12 to 15%. As you do mention, we are quite extended on sort of debt to GDP metrics, and the individuals as well, debt to income. So as we saw in the last 2 years, I think we will grow that sort of top line at much lower than historic rates. So I think most of the banks would be targeting sort of high single digits for the current year, as opposed to the historic long-term rate for about 15%.
Thanks, Johny. Let's come to Standard Bank now. Earlier this week, Standard Bank advised on merger and acquisition deals worth more than 10 billion rand between Chinese companies and companies on the African continent. Standard Bank's two large deals were concluded in 2011, namely the $1.3 billion Metrec sale to Jinshuan and the 25% sale of the Shanduka Group to China. Let's start with you, Viv. Obviously, these are quite big deals for Standard Bank. ICBC is a 20% shareholder in Standard Bank. But I just want to get your sense on how well that relationship is going. We saw ICBC opening up a branch in Cape Town towards the end of last year, essentially coming into Africa on their own. What is your take on that?
Look, I mean, when ICBC first bought into Standard Bank, it wasn't just because of Standard Bank's great business and the idea of making profits at Standard Bank. It was the idea they needed a foothold in Africa in order to do these kind of deals, in order to get the resources that China needs for its growth. And I think that's kind of the path that we've been looking forward so far. Yes, they have entered into Cape Town, but I still think with the kind of size of deals we are seeing that are going through Standard Bank, and as well as Standard Bank's expansion into Africa, it still is probably their first shot in terms of actually looking at, getting growth in Africa. It is going through Standard Bank as opposed to doing it on their own.
Let's come to Johny now in Cape Town. There was a call towards the end of last year for Standard Bank to up its dividends. Now, unlike their peers, they actually didn't cut their dividends when earnings were declining during the tough economic environment. But now that their earnings are going up, they want to go back to that long-term dividend cover of 2.5 times. Why will they not reduce the cover? And people are saying that there will be capital injections coming into Standard Bank from the sale of its 36% stake to Russia's Troika, which is worth $372 million, as well as the sale of its Argentine unit that's going to net them a fair amount of money too. What will be the outlook for their dividends?
Well, Standard Bank has kept their dividend flat at about $3.86 for the last 4 years. Our view is that they will probably pay a similar amount again in the current year, even though earnings are expected to grow by about 20%. Effectively, we'll just see a rebuilding of that cover in the current year. So I don't see much scope for the ordinary dividend increasing materially when they release their results in early March. In terms of some kind of special distribution, a lot of the South African banks do sit on a fair amount of excess, but I think they are awaiting the regulator deciding how much national discretion he will allow when implementing the new Basel rules. And for some banks, Standard Bank in particular, obviously the proceeds from the disposal of some of those foreign entities. So I wouldn't look to an immediate kind of distribution from some of the big banks, but on a 12 to 24 month view, you might see some of that excess returning to shareholders. Bear in mind they hold a lot of capital against the loans, and as we spoke about earlier, if their loans aren't growing but their capital is growing, then there may be some scope for them to return some of their excess to shareholders.
Just staying with you in Cape Town, Johny, could you give us your take on the Basel III requirements and what the impact is going to be on the likes of Standard Bank?
From a capital point of view, Standard Bank and most of the South African banks, like I mentioned earlier, are very well capitalized. So they'll meet the Basel rules fairly easily. The liquidity ratios are slightly more different. I don't want to get too technical on the show, but effectively the South African banking system, as on most banking systems, are not adequately matched. In other words, a lot of banks have very long-term assets, being mortgages, for example, but their liabilities tend to be a lot shorter. And the Basel rules, amongst other things, are trying to narrow that gap. And that is going to be a 5-year structural issue that the South African banks will have to face, either trying to shorten their assets or trying more likely to actually lengthen their liability profile.
Viv, let's come to you now. We saw the share price closing just over 105 Rand today, but still below the 12-month high of 107.85 Rand. What do you think is on the horizon in terms of Standard Bank's share price?
Look, I don't think it's going to be doing a gangbusters. I don't foresee any kind of doubling of the prices of Standard Bank or any of the banks we're seeing out here. I do expect it to do reasonably well for the year, probably returning possibly around the 110 level for the entire year. So it's not looking at a huge amount of growth in the company going forward.
Time to go for a vote now. Tell us whether you think Standard Bank is hot or not. Yeah.
Look, I think in the short term, probably not. But if you're looking in the longer term, it's pretty much a bet on South Africa and to a large extent on Africa. And I think that's a pretty good bet to take longer term. So I think it's hot.
Oh, definitely. Let's move on to Johny in Cape Town. How do you feel about Standard Bank, hot or not for you?
I think on a 3-year view, Standard Bank is quite hot. They are going through a restructuring phase. You may recall December 2010, they had to cut a number of staff out of a number of their branches, both internationally and locally. There's a couple of issues that they're trying to work through in Africa. There's still too much capital in Africa, not earning an adequate return, but that is going to take some time to turn around. But I think on a 3-year view, Standard Bank is a good bet.
Standard Bank's a good bet for Johny on a 3-year view. We'll actually come back to you because this is actually your stock pick and will allow you to elaborate a little bit more. For now, let's move on to Capitec. And Viv, I'll start with you. This is a bank that's had a proud reputation of having the lowest fees in the country, but now they're aiming for higher bank fees and they want their non-lending income to cover at least 40% of its operating expenses by 2014. It's now just over 30%. What's your take on this?
Look, as we mentioned earlier, the fact of the matter is that interest income is obviously under pressure. It's very variable, and fee income is much nicer. It's basically it's annuity income. It's much more predictable. You're not as subjected to the variations in the economy, etc. So it's obviously in its benefit to move towards a higher fee structure. More fees become a larger part of the revenue. The question now, as you mentioned, of course, is the fact that they are perceived to be the lowest cost bank, and they are the lowest cost bank out there. The question is whether or not they'll be able to provide enough new services and new opportunities to their customers to justify this increase in fees that they're probably going to be asking for.
Well, they've always been at the forefront in terms of innovation. They open on Sundays. They've extended their banking hours. They have a very simple application process that's paperless. Do you see some innovation coming through in terms of the products that they're going to be offering?
Yeah, probably. There needs to be something that's more comparable to what some of the larger banks are offering. Some of the online stuff. I think that they are going to be pushing through that. They are going to go through a MasterCard debit card that's going to offer online banking and booking, etc. Which, of course, if you look internationally, that's probably where most banks have this facility being offered, because the consumer right now is becoming more and more sophisticated in terms of online retailing, etc. And a bank that doesn't offer you the ability to do that is probably going to be at an incredible disadvantage going forward. So these new services have to come into play. But the question is, will the customers believe that these services will justify the increases in fees they're probably going to be asking for?
Let's come to Johny in Cape Town now. In November 2010, they did a massive rights issue of R1 billion actually, and placed 4.6 million new shares, which were essentially worth 4.9% stake in the company, nearly 5% stake. Do we anticipate Capitec going to the market again in terms of raising, and what was the impact in terms of Capitec's current shareholders? Obviously, there must have been a dilution, but they said they wanted to increase institutional investors. Did this have the desired effect of increasing the shares' liquidity, though, is the question to you, Johny.
Look, in terms of them coming back to market, again, it all depends on how quickly they grow. As I mentioned earlier, banks hold capital against their loans. If their loans are growing at the rate that Capitec is growing, it is likely, and some of the numbers I've seen from the brokers out there, is that at some point either this year or early in 2013, Capitec might need to come back and raise more Tier 1 capital. So that's definitely, I think, on the horizon. In terms of dilution, it really just depends on the individual shareholders, whether they think that the price that the new shares are being issued at is going to be compensated down the line by extra advances growth.
Let's come to you, Viv, and talk about Capitec's aggressive expansion plans. They've got 32 million clients. They've got 19 branches. 202 ATMs were open since February 2011 year end, and they're planning to roll out 36 new branches. Isn't there a natural limit to the extent of growth?
Yes, I mean, look, the share price and the PE ratio it has at the moment, is quite high. Therefore, we are basically looking at a company that has to grow to justify the current price that it has. Look, it's quite small as well. It's smaller than the other companies we're talking about. So even though there probably is a natural limit to how big it can get, it's quite small at the moment. So it's starting from a low base. So the high growth rate is possible. The question arises: are they going to be too aggressive in the market? And I do foresee there are going to be difficulties coming for the South African consumer over the next few years. Inflation is probably going to rear its head again. We are going to have difficulties in terms of disposable income, etc. going forward. The economic troubles that we are seeing in Europe are not going to be going away, and we are going to see them spreading throughout the world, and to a certain extent we're going to be affecting South Africa as well. And to be expanding into this kind of market is going to be quite difficult.
Let's come to Johny in Cape Town now. They're working on a plan to offer customers an unsecured loan of 500,000 Rand in less than 30 minutes. They currently offer loans of up to 120,000 Rand. Now, the unsecured market has got very high margins, which obviously justifies its attractiveness, but it's also relatively new and an unsophisticated market. So Capitec must have credit assessment models that are second to none. How are they going to protect themselves from the risk of a default with these higher unsecured loans?
Look, the idea that most of the micro lenders will try to convince investors of is that the two avenues that they've been using to grow their book of late, which is A, increasing the term of the loan, and B, increasing the size of the loan, is justified based on better risk models, etc. We are concerned that there has been a mountain of unsecured debt that has been put out into the market by the likes of Able, Capitec, and the big four banks as well. And we do question the robustness of any model if global conditions deteriorate. We have inflation rising in South Africa, and consumers find it more difficult to obviously service their debt. Just the amounts that they are willing to lend, sort of 100,000 for 5 years. I can't find anyone who would lend me 100,000 Rand for 5 years, and these guys seem to be doing on a sort of a daily basis at a rapid pace. So that does concern us.
Viv, let's come back to you now, just touching on the question in terms of the products that they're offering. We're seeing them going into the credit card space. Do we anticipate vehicle and asset-backed loans coming into play?
Probably they will. I mean, they have to be expanding their base. I mean, the customers, of course, at the moment are looking for the low-cost bank that they currently are. But I mean, a customer, as you go up the scale, they will demand better services from your banking, more services, and this is something they probably will have to go through in the future, I would think.
Now, this is a share that closed at 105 Rand this year. Oh, no, that was actually Standard Bank.
Looking at 75
Oh, yeah, 75 Rand. What do you see on the horizon in terms of Capitec's share price?
Look, I do think the price may go higher. This company has done really well recently, so you could see a big improvement. But I do think the risks here are significantly higher than someone like Standard Bank. So for me, it's not hot at the moment. Not hot at the moment, and still trading below the 12-month high of 196 Rand 60. Johny, let's come to you in Cape Town and get your take on Capitec, hot or not?
Yeah, I think it's too expensive. You're paying, more than 20 times historic earnings for the company. I think some of the micro lenders will face some headwinds in the coming years, and I don't think the price is justified at these levels.
Price is not justified at these levels, so not hot for Johny.